Now, again, if it's $10,000 extra in tax that you paid in AMT, you go to the next year. Federal income tax is this much, AMT is this much. There's a difference of, let's say, $3,000. Then from that $10,000 last year, you carry it forward. You can deduct $3,000, and then you would carry $7,000 forward to the next year, run the same calculation, find the difference, and deduct that amount, okay? If this is you, it's just best to get a tax professional to work with. They can help keep track of this and make sure that you are carrying forward and getting the deduction if you paid AMT in a year and then you don't owe AMT in other years. All right, really quickly then, we're going to just talk about 3 basic strategies to handle this. Sometimes there is really nothing you can do because it's just the way the income lands, right? You're going to exercise your options because it's a tremendous value and you want stock in the company and it's a great discount and all that. So sometimes there's just not a whole lot you can do. There are some things you can do to mitigate the impact, even if we can't altogether avoid it, okay? So number 1, we can make sure that we get more income in that year. So if we are projecting to owe AMT, pay the AMT in a given tax year, we can try and get more income into that tax year, okay? Because you're going to pay higher rates anyway, according to AMT, right? Like 26 or 28%, which leads generally to a much higher effective tax rate than the federal income tax calculation. And so if we add in more income, then what we're able to do is potentially be taxed at the federal level and end up overall earning more income while being taxed the same amount or even maybe a little bit less. Okay, this is a little bit hard to wrap your mind around because remember, we're running parallel calculations and it's just because your tax liability on the AMT side is higher. So if you add in more income into that tax year, then you're also going to increase the taxable income on the federal level to the point where maybe you match the tax liability that you would pay with AMT. So you end up paying the same amount in tax as a minimum, but you've earned more income for the amount of tax that you paid because then you're using this other calculation, okay? That is a little bit confusing, I realize, but that's one of the strategies. You can add in more income so that you're taxed on this level and you end up earning more income for the amount of tax that you're paying. Second one is moving deductions out of that tax year. So certain deductions you're not getting credit for under AMT, right? They're excluded deductions. And so why claim those deductions in that tax year if you don't have to? Because you're not getting credit for them, so to speak, because they're using the AMT calculation. So one example of this would be charitable contributions. Potentially, it could be contributions to pre-tax retirement accounts. All of these things deduct income in the federal income tax bracket system, but they are not deducted against the AMT. So if you're taxed, if you pay AMT that year, then essentially you did things to maximize your deductions, but you're not getting credit for them over here. So what you would do is you would move those to another tax year. So instead of doing your charitable contributions that year when you pay AMT, push them to the next year. Instead of doing pre-tax contributions, do Roth, because it's not going to matter. You're not getting a tax deduction anyways. So you may as well pack in Roth money and get tax-free money on the end. So some of these deductions, especially charitable, you can be like, all right, let's not donate anything this year. We're going to move all that money we would have donated to next year. We'll do it next year with next year's contributions and kind of double up. Then again, on the regular federal income tax system, you're removing those deductions, which is increasing your tax liability to the point where you may end up having the same tax liability. And then the next year, you use the deductions to lower your tax liability when you don't have AMT coming into play. That's number 2. Number 3, defer the timing of your exercise of your ISOs. In other words, let's say you have a grant and you get a new vest every quarter. Sometimes that first vesting period, you get a bonus amount, right? So let's say you get a grant of 10,000 shares. Sometimes they're like, and it's broken up over 4 years and or whatever, and quarterly. So otherwise it would be equal. But the first time you get to actually vest, 2,500 shares. And then after that, it's divided up evenly per quarter for the rest of the vesting period. That happens very commonly. In that case, you have a lot of shares that you could exercise in that tax year. And if you exercise all shares, then you might hit the AMT calculation, right? Use from that bargain element. You just run some projections, estimate your bargain element, add that back in, run the calculation. Again, work with a tax professional. But they can say, oh, yeah, you're tipping into AMT this year. What are we going to do about it? It's like, okay, well, maybe we don't exercise all of those options this year. So let's exercise up to the max that we can do before hitting AMT. And then the next year, we'll do the same thing and we'll exercise, and we'll do the projections and exercise up to the limit before we get taxed on AMT level. So you can do that. Sometimes you might want to exercise in a given tax year if you have really high income, because you still be taxed at the federal income brackets instead of AMT because you have a lot of income that year, for example. And so maybe you want to exercise as many as you can in that tax year to take advantage because you have a higher limit, a higher threshold, because there's more income on the regular federal income tax calculation. Okay, we're going to leave this video here. Okay, as you can tell, it is complex. And we don't need to go into every nitty-gritty detail for you to understand generally what's happening and some of the contributing factors. So just work with a tax professional. Pay the $500 or whatever it's going to take and get their help to run projections, plan in advance, and make sure that you are maximizing especially if you have ISOs and you have a large bargain element, that you are optimizing over tax years to pay the least amount of tax. That's what you want to do. And it's always just best to work with a tax professional because they can keep you straight year over year instead of you like trying to go back to TurboTax and trying to figure out, well, how much did I do last year? And how much can I carry forward? Just work with somebody and they'll take care of it for you. So that's alternative minimum tax. And we are going to move on from that onto some other additional taxes. All right, guys, talk soon.
Understanding the rules helps you plan smarter.